Welcome back to Business Legacy Summits, everyone. I'm Troy Noor with Boulevard Wealth Management, and I'm here with Neil Rogers from Platinum Bank. Good to see you again, Neil.
Yes, good to see you as well, Troy. So I appreciate setting us up here for the second half. And on the first half, Troy, we discussed a lot of the things that are kind of happening inside the market, like valuations, earnings, artificial intelligence, or AI. I'm looking to kind of zoom out right now and kind of spend a minute on more about the broader economy and a lot of things that my clients are talking about. Headlines can be confusing. One day we're talking about the economy slowing, the next day we're talking, employment numbers are stronger than expected. Kind of help me understand, kind of separating the noise from what's really happening.
Yeah, that's a great question, Neil, because the economy certainly isn't firing on all cylinders, but we're not stalling either, right? If I had to describe it in one word, I would say that the economy is normalizing. Last year, we experienced some exceptionally strong quarters due to the pent-up demand that we're still working off from the pandemic era crisis, and then also companies' accelerated investment in technology. Naturally, those growth rates weren't going to continue indefinitely. Today, we're seeing growth settle back more closer to its long-term average, and that's actually a healthy development, Neil.
So the slowing growth isn't necessarily bad news.
No, exactly. Yeah. Sometimes investors equate slower growth with recession, and those are two very different things. An economy growing at a 2% rate isn't weak, it's simply growing at a sustainable pace. One area that has weighed on recent GDP growth is international trade, right? We've imported a tremendous amount of technology infrastructure, particularly semiconductors and AI related equipment, to support the investment boom that we're seeing in corporate America. While those imports temporarily reduce GDP through the trade balance, they're also investments that should improve productivity over many years. So when I look beneath the headline numbers, I actually see business investing in future growth rather than preparing for a contraction. And that's a very positive sign.
And I think it's an important distinction because we're seeing business owners that I work with, they're still investing. Are they being cautious? Yes, they're being cautious, they're being thoughtful, but certainly they're not pulling out. They're not packing up, they're not going home. They're still upgrading systems. They're investing in their, cybersecurity, which is a banker I love, of course, adopting AI tools, looking for ways just to be more efficient. Those aren't the actions of, companies preparing for a severe recession.
Yep, I completely agree. If anything, executives are becoming more selective with where they invest, but they're still investing. That gives me confidence that corporate America remains fundamentally healthy.
Yeah, appreciate that. Let's talk a little bit about inflation because that continues to dominate a lot of my conversations. I'm sure other conversations as well around interest rates. How do you kind of see inflation evolving for the rest of the year?
Yeah, I think we're much closer to the end of the inflation story than the beginning. We peaked last month at 4.2%. We're talking just after we had the release of the CPI numbers this morning at 3.5, so we're starting to come back down. Now we do see oil starting to come back up again because of the increased conflict in the Middle East. But I think that is temporary in nature. We're gonna process that through. Earlier this year, inflation accelerated so much, because of the energy prices, the lingering effects around tariffs. Markets immediately assumed that inflation was beginning another sustained climb. But I'm not convinced that's the case. Many of these pressures appear temporary, as I said. Many of the energy prices have already begun to ease considerably. We're off our peaks at about 450. Now we're coming down to about 375 on the gas prices. And as those higher prices roll off those year-over-year comparisons, inflation should gradually moderate. I don't expect inflation to immediately fall back to the Federal Reserve's 2% target, but that takes time. But I do believe we're moving in the right direction, Neil.
Okay, good. So we're viewing the recent increase as a bump in the road as compared to reversal of the trend.
Yeah, that's exactly how I see it. Inflation rarely moves in a straight line. We should expect periods of where it temporarily re-accelerates, right? And before continuing lower. The important thing is whether those increases become embedded throughout the economy. And right now, I don't think they have.
Right. Naturally, inflation leads kind of directly into the next question everyone's asking is when is Federal Reserve going to finally lower rates?
It's funny when you say finally lower rates, Neil, because the market's actually pricing in rate increases. which is fascinating. I don't agree with it. I think we're going to process this through, but they're pricing in a quarter rate hike here, not in July, but in September. But I think that we're going to process this inflationary pressures, right? And if I had to summarize the Fed's current mindset, I would say it's patience, right? They're in no hurry. They've spent several years fighting inflation and they don't want to declare victory prematurely. Markets have repeatedly anticipated actually multiple rate cuts, only to watch those expectations get pushed further into the future. So if they were wrong then, I think they're wrong now. Sorry, right? They're watching, but you know what? At this point, the Federal Reserve wants unmistakable evidence before making its next move, right? We're watching two variables, and they are watching two variables very closely. First, is inflation continuing to lower? And then second, is the labor market beginning to weaken enough to justify additional monetary support? Until they have clear answers to those questions, I think they remain on hold.
Yeah, from a banking perspective, we're seeing the same uncertainty reflected in our conversations with our borrowers. Many owners are asking, have they adjusted today's, interest rate environment? Instead of waiting for dramatically lower rates, it seems like some people are making investment decisions based upon the, kind of the current financing costs because they've realized that higher prices, higher rates might be with us longer than originally expected. As you kind of made the comment, you keep on saying, well, down, down, this future keeps on pushing out a little bit.
Yeah. Yeah, that's an excellent observation, Neil. Businesses are remarkably adaptable. Once they understand the rules of the game, then they adjust. The uncertainty is often more disruptive than the interest rate level itself. Today, we're moving toward more clarity, and even if those rates remain elevated, now people know how to basically base their models off of and make decisions.
One area that consumers have definitely benefited from is fuel prices. Right at this exact second, it doesn't maybe feel like that, but I think if you look over the last 5 years, we're definitely sitting in a lower spot. And I think you mentioned earlier about kind of where it's going to go down. So gasoline coming down meaningfully, from where it was a couple of years ago.
Yeah. Yeah, it really has. And when you say a couple of years ago, I'm really looking back to 2022. So probably 4 years ago, when we had the Ukrainian crisis, we had, gas peak at about $5 a barrel. We're well below those levels. And so when you compare to today's prices to those spikes, that we experienced, the energy shock that we experienced, the difference is substantial. That's important because energy touches virtually every part of the economy. Lower fuel costs reduce transportation expenses, they lower shipping costs, they reduce costs for manufacturers, and perhaps most importantly, they put additional discretionary income back into consumers' pockets. For many families, gasoline functions kind of like a tax, right? When prices fall, consumers suddenly have more money available for restaurants, travel, entertainment, or simply to save, right? And that's supportive to overall economic activity.
We see that reflected in our client behavior. You kind of talked about, the money in the consumer pockets. As as household cash flow improves, families start thinking beyond simply paying the monthly expenses. They start looking at excess cash, reducing the debt, maybe prepare for some future opportunities, and lower energy costs create that flexibility.
Yeah, that's exactly right, right? Sometimes relatively small changes can have surprisingly meaningful economic impacts.
Another topic that's received tremendous amount of attention is tariffs. How significant are they in your outlook today?
Yeah, today certainly remain part of the conversation, but they're becoming less disruptive than many feared several months ago. As policy has evolved and certain tariffs have been reduced or delayed, importing goods has become less expensive than many of the businesses had previously expected, and that helps relieve some of the inflationary pressure. Now, we're still importing enormous quantities of technology equipment because of the AI investment. That's contributing to our trade deficit in the short run. But as I've already said, I view those imports as a productive investment rather than a structural weakness. They're building the infrastructure that should improve productivity for years to come.
And that goes kind of into the big question that we keep hearing out of our clients is, are we heading into recession?
Yeah.
Kind of, what's your side? What's your answer on that one, Trey?
Based upon everything we see today, we don't believe recession is our base case scenario, right? Could one occur? Of course it could, but unexpected events always happen. But that's why risk management remains central to everything that we do. But when we evaluate employment, corporate earnings, consumer spending, business investment, and financial conditions collectively, the evidence simply doesn't suggest an imminent recession. Most economic models place recession probabilities below a 1 in 3. That's not zero, but it's also far from saying a recession is likely. To me, the more probable outcome is continued moderate economic growth with periods of market volatility. That's a very different environment than the severe downturn many investors continue to fear.
Which again brings us back to what you had said early. Volatility, shouldn't automatically be interpreted as you're going to deteriorating fundamentals.
Yeah, exactly. Markets constantly react to uncertainty. Economies move much more slowly. When we separate market emotion from economic reality, the picture becomes much clearer. And right now, while we're certainly monitoring risks, we continue to believe that the underlying economy remains on solid footing.
That's a great place to pause because in the final part of our conversation, I'd like to shift from the kind of the macro economy into what it means for kind of investor portfolios. For several years, in a fixed income took a backseat to equities. Today, that's no longer the case. Let's spend some time discussing why bonds are attractive again after a while here, and how we're looking about today's, interest rate environment and what opportunities we're seeing in both investors and business owners.
Yeah, I think that's a perfect transition because for the first time in quite a while, bonds aren't simply providing diversification, they're actually providing a meaningful income again, right? And that provides, you know, great ballast to portfolios, by the way. The higher the interest rates, we've got more time to come down. And then, so if we enter some kind of disruptive period, interest rate comes down, bond prices come up. So I think bonds, especially now, can play a very important role in the portfolio. So, look forward to picking up that conversation next time on our Business Legacy Summits. See you next time, Neil.
Sounds great. Thanks, Trey.